Welcome to Finance with Abram. In this video, I want to tell you about how I beat the stock market in 2022 with 3 investment strategies and mainly 3 stocks. Yes, as you see right there on the graphs on the screen right there, that is one of my portfolios versus the Dow, the Nasdaq, and the S&P 500. So yeah, I'm right below that 20% gain of the year. The main 3 stocks in my portfolio that helped me achieve this performance versus these indices, I still hold. However, I did do a lot of selling in January, and I'll show that here on the screen right there. As you'll see right there, yeah, first week of January, I did a lot of selling. No, I'm not a magician. No, I don't see the future. I did not know the market was going to crash as much as it did in January later that year and throughout the year in 2022. I mainly sold because I had a major expense with my house that I needed to pay on, and one of the ways I do that, I didn't want to pull from my savings, and I knew I had some stocks that ran up a lot in the past year with COVID and everything. Like you'll see right there, Microsoft and Disney. I mean, you see the prices I sold at? Yeah, those stocks aren't anywhere close to that price right now. And throughout the year, they were way lower than what they are right now, even and at the end of 2022. So yeah, took some nice profits, some nice gains on those stocks. And those are stocks I want to get back in for sure. Microsoft and Bank of America. Well, I do have Bank of America in another account, but JP Morgan and Disney. And so yeah, there were stocks I want to get back into, but yeah, they ran up a lot. So I decided to sell those, and I hung on to some other stocks, and these 3 ones right here. And I'm gonna show you in this video that I still have, and I did not sell any of them. And I don't always beat the market every year, every month, or anything like that. My other portfolio, it beat the market indices, the Dow, the Nasdaq, and the S&P. However, it didn't end the year in positive territory. It was negative for the year in 2022. My other portfolio that has, CVS and Target and Apple and NRG and several other stocks and everything in there and ETFs. So yeah, it's doing well now in 2023 and everything. However, in 2022, yeah, I mean, a lot of those stocks in that portfolio are doing well, but there were some that got hit because that portfolio was a mix of value, income, and growth. So yeah, there were some of those growth stocks that didn't do too well. So with this portfolio, however, as you see, beat the indices in the positive territory. So that's why I want to focus on this portfolio versus 2022, because 2022 was a rough year in the stock market. As you'll see right there, how those indices went throughout the year, down, up a little bit, down, up a little bit, down, up a little down. Yeah, so you see it. But let's get into the 3 investing strategies and the 3 stocks that helped me beat the stock market in 2022. Now, the first strategy I want to talk about is buy and hold investing. Now, overall, I'm a long-term investor. So I don't do a lot of swing trades or day trading or anything. I don't do any day trading at all. I have dipped into that, but I haven't done that in years. Swing trading, I've dipped into that. I haven't done that in a while either. I'm mostly a long-term investor. I mean, months, years. I'm trying to hold those things for decades now, So definitely years. But that is my main focus right there with my portfolios. This one, my other portfolio, my retirement accounts, long term. So buy and hold investing is very important to me. Now, buy and hold investing is investing in stocks that you think will perform well over many years, not something you think is going to run up next month, next week, not even in the next couple of months. These are stocks that, after doing your due diligence, with the fundamentals and the financial analysis, these are stocks you believe that will do well over many years because you're going to hold on to it for many years. So yeah, it's going to fluctuate, it's going to move up and down, but overall, after 5 years, 7 years, 10 years, 4 years, is going to be doing well. That's what you want to do with these kind of stocks and these kind of investments right here with buy and hold investing. Now, buy and hold investing is not selling when the market is rattled, but instead holding throughout individual stock and stock market fluctuation. Now, overall, of course, you have stock market fluctuations where there's a lot of volatility and they pull stocks up and down with it. Even if the stock, is performing well with their earnings and everything, overall, if the market is getting hit, a lot of times it's going to bring down a lot of stocks with it. The stocks that aren't doing so well because of the market, because of the economy, and also stocks that are doing well in their specific sectors and individual and everything. So buy and hold investing is not getting rattled, not panic selling, holding on to those quality stocks and those quality investments that you believe will do well over many years. Now, holding on to investments helps investors take advantage of compound interest because just like a savings account, from month to month, you let that interest gain on your savings account. Now you're making interest on your principal amount you have in your savings account and the interest that you gained for that previous month, and so on for various months. So when you're doing dividend reinvestment, you're getting more shares of that stock that pays a dividend. So next time when a dividend is paid out, you're getting more dividends because you're getting the amount of dividend percentage, that dividend yield on your total amount of stocks held. So that previous month where you got shares because of dividend reinvestment, well, then the next month you get more because of that dividend reinvestment, so on and so on. So that's a compounding effect. Very awesome is the compounding effect when it comes to interest and dividend reinvestments. It's very powerful. Now, the stock market can definitely be volatile, but history shows the market has been able to recover from declines and provide positive returns on quality long-term investments. That's where you have to zoom out. Because if you focus too much on the now, the next week, and the last week, you'll start panic selling. You'll think, oh, this is it for the stock. Oh, that's it for Microsoft. Oh, that's it for Google. That's it for Bank of America, JP Morgan. That's it. You just stocks that move around like this. And those are some, big quality stocks that have been moving up and down. You have the fast growers, Tesla. Oh, no, that's it for, is it really? That's it for, these are some quality, great companies right here. So you zoom out and if you would have panic sold Tesla, years ago instead of holding on to it, you'll be out of massive gains, and that's a growth stock. It's kind of different than these other stocks, but I'm kind of wrapping them all in together because there are quality stocks on both spectrums, the growth area and the value area and the income area. But what you want to do is you want to hold on to it long term when you're doing buy and hold investing, because you have looked at the fundamentals, you've looked at the data, and you believe that these stocks will do well over many years. And so that's overall how history showed in the stock market that there's positive returns. So overall, the S&P 500, the Dow, you zoom out of these years and everything, yeah, maybe a year or two, some multiple years that are negative, that are doing bad. You zoom out decades, 10 years, 20 years, 30 years, and overall, the stock market is up overall. Now, also, when buy and hold investing, you're participating in the market's biggest days, because missing out on a few key days or weeks in the stock market can have a significant impact on your portfolio. And I want to show you this really awesome graph right here. So check this out. These are returns on the S&P 500. This is the performance of $10,000 invested between January 2nd, 1990 until December 31st, 2021. So yeah, several decades right there, but look at how different this is when you miss out on certain days right here. So you're fully invested. That $10,000 right there, $263,217, 10.76%. You miss out on 10 days, that drops to 8%. Still nice, but look how drastic that is. Now you want to go down even further, miss out on 30 key days, 40 key days, 50 key days. You see the difference right there. Let's just pick in the middle. You missed out on 40 of the best days. That amount that could have been 263,000 is now 30,000. Now you got 3.5% instead of 10.76%. So yeah, those percentages don't look like much, but over the years, that adds up a lot, or that could be a significant impact to your portfolio missing out on days. When you're doing buy and hold investing, you're holding on throughout these ups and downs. So you're not missing out on significant days right there, because you're holding and you're buying throughout, and you're holding throughout, and your dollar cost averaging, you're holding on throughout the ups and downs. You're not panic selling when the market is low and then buying back in when it's high because you think everything is great and the hype is there. And sometimes, yeah, over the next decade or so, you can be up higher than when you bought at the top and the highs. But overall, if you would have kept it down there when it was low, or you would have bought more when it was low, something like that, you're going to be doing even better. So you see how drastic this is right here when you miss out on some of the best days of the market. So buy and hold investing right here, very important over the long term. Now let's get to the other investment strategy. Now, value investing, you may have heard this term before, associated with Warren Buffett or Benjamin Graham, two of the most known value investors in the stock market overall in history right there. Now, value investing is buying undervalued stocks with strong long-term prospects and potential. And value investing is also investing in stocks or sectors that are out of favor, which causes them to be undervalued. Something's going on in the economy, or something's going on with that individual stock that's temporarily making that stock be undervalued. But overall, long-term, the data and everything's there, the financial reactions, the analysis of the company, of the stocks, of the sector is favorable. So, but right now, that moment is unfavorable, which causes that stock market price to overreact. There's a lot of overreactions that happens in the stock market that affect the price, but the underlying fundamentals is what you have to look at, because that can cause stocks to be undervalued, which is a great time to buy right there. As I was saying, value investing is taking advantage when the market overreacts to bad news that results in stock price movements that don't correspond to a company's long-term fundamentals. Kind of got ahead of myself right there when I was talking about the previous statement right there, because that is exactly what I just talked about. And when the market overreacts to bad news, that can cause a stock to become a value stock and become undervalued, and that is usually a great time to buy right there. Now, also, value investing is buying stocks that are underpriced relative to their intrinsic value or book value. Now, intrinsic value is typically a combination of financial analysis fundamentals based on a company's financials, including revenue, net income, cash, debt, and etc. Book value is typically associated with like bank stocks and maybe insurance stocks. Some of those kind of stocks right there, you have to look at what's on the books of these companies right here that give them that stock price, that can give them a fair book value. So a lot of times banks are looked at upon their book value rather than the intrinsic value when you're trying to find out if you're underpriced or not. And some of the main metrics that are used to determine if a stock is a value stock are the PB ratio, price to book ratio, the PE ratio, price to earnings ratio, and free cash flow. Now, on this chart right here, you'll see value investing broken down in a very simple way right here. You on the left right there, you got the share price. At the lower, you got the lower the share price, and at the top, you got the higher the share price. And on the other axis, you have time. So on the left, a few days, or it gains a few more days, or years, or however you want to do it. Right here, we'll just say this is in years. So you have year one right there on the left, and then you got 20 years on the right there. So what this is saying right here is that the intrinsic value changes throughout the market cycle right there with the market price. But the market price, you look how drastic the market price moves around the intrinsic value. Intrinsic value is going to be more steady because the fundamentals of companies typically, depending on how much they grow. If this is a high growth company, the intrinsic value is going to be, rising, more rapidly and everything. If this is a company that's growing kind of steady, kind of solid, well, the intrinsic value is going to go up, but it's going to be more, stable and everything. And this is a basic chart right here. There was online. I've seen it in a couple of articles, but it really maps it out right here because with the market price, sometimes you're going to be able to catch a stock with the market price under the intrinsic value, which would make it overpriced, which would be a great time to buy. So if you're doing the calculations and everything of the intrinsic value and the market price is underneath the intrinsic value, well, that's kind of like a, radar alarm or saying, hey, this is underpriced, great time to buy probably. And then when the market price is over the intrinsic value, when you're doing the calculations and the market price is over, that's not going to necessarily be a good time to buy. Like overall, like long term, it can still lead you to gains, but you got to hold on to longer to achieve those gains. As you can see on the chart, sometimes the market price can be extremely overpriced compared to the intrinsic value. And this is a way of looking at how the intrinsic value can compare to this market price. Sometimes it'll be right in line with it, sometimes underpriced, sometimes overpriced. Now that's the second investment strategy that helped me achieve great performance in 2022. Let's get to the third one. Now, income investing is a strategy of building a portfolio specifically structured to generate regular income. And now this is investing to create a reliable passive source of income. It's typically safe and secure investments that have a history of stability. However, several forms of income investing are not without risk. They're usually less risky and volatile than high growth investments, but often not as much potential in the gains though. Now with income investing, the regular recurring income can be in the form of dividends, bond yields, and interest. Now, some of the examples include dividend-paying stocks and ETFs, exchange-traded funds, bonds, money market accounts and funds, real estate, whether it be physical real estate that you're getting rents on, or REITs, real estate investment trusts, which you can invest in throughout the stock market, certificate of deposits, CDs, savings accounts, and annuities. Those are some of the main examples that people use to absorb and obtain that passive income right there. Now, a lot of investors that use the income investment strategy use the income that is paid to them from their investments to use in everyday life, whether it be to pay bills, take vacations, buy food and necessities, buy clothes, buy, something in their hobbies or whatever, etc. Now, with income investing, some people reinvest this in their investments. Like when it comes to dividend stocks, for me personally, what I do with my dividend paying stocks is that I reinvest into that same company typically. So I'm doing dividend reinvestment, which is going to gain that compound of more dividends, and more dividends paid out. So more shares of the company every quarter or every month, depending on how often that company pays out dividends. Now, income investing in my portfolio right here was mainly focused on dividend paying stocks. Now, I do have a savings account that pays a very nice APY, and I do have videos on savings accounts, and lists and everything like that. So check out my channel for more information on savings account. That could be a great way to have some income investing going on in your overall portfolio, not your like specific portfolio like I'm talking about in this video, but overall, your overall investments in your life right there. Now, certificate deposits, I have videos on those as well. That's a nice way to get some income investing going on. But specifically for this portfolio that beat the market in 2022, I mainly had dividend paying stocks right here. That's how I beat the market right here. But you can also do this, like I say, with bonds, with real estate overall like that. And so what helped me out also throughout the year is having, nice savings accounts that pays a nice APY. Those are some of the examples to obtain the income investing. But when it comes to actually investments in an investment portfolio, like at Fidelity or E-Trade or SoFi or Webull or however, whatever you use, a lot of people use dividend paying stocks and dividend paying ETFs to obtain that right there. So that could be a way of getting that passive source of income coming in monthly or coming in, quarterly, where you don't have to do dividend reinvestment. You can just take that money and then use it for your, everyday life bills and everything, or you can use it to buy other stocks that you're interested in or other ETFs, or you can do dividend reinvestment where you just get more of that same stock or ETF. So it's basically up to you. You could use income investing to get money from your investments to use like in everyday life, or you could just get it to increase your income investing or, increase your growth investing or anything. And speaking of growth investing, let's look at growth investing versus income investing. Now, growth investing focuses on growing the original sum as much as possible, whereas income investing focuses on providing a steady stream of income. Now, growth investors, they seek stocks of companies and investments that show signs of rapid growth. They want to get those major gains. And that's what it comes with the growth investor. You get a lot of growth stocks. Like overall, you can look at charts and everything of growth investing versus income. Sometimes income investing is going to do better than growth. Sometimes the other way around. In 2022, income and value investing did better than growth. But the year before that, after COVID, when stocks started running up rapidly, growth stocks were doing amazing. So it really just is good to find a balance, whether you want to do a portfolio of all of income and a portfolio mostly of growth, or mix it in or something like that. You definitely, I'm not going to give advice. This isn't financial advice. This video is for, educational purposes only and entertainment. Me personally, I like to do a mix. I have a portfolio right. This one right here is mostly income and value investing. When I have my other portfolio, that's a mix of income, value, and growth investing. So I kind of want to separate that mainly into different kind of portfolios, or I may just keep it the same. But I do like having, exposure to growth, income, and value investing. And back on course to the video. All right, growth investing is typically more risky with more volatile price movements, whereas income investing is typically less risky with fewer volatile price movements. Now, growth investments have a greater growth potential and ability to turn into income and value investments over the long term. So eventually, those growth stocks, those growth investments, they'll fizzle down some. You can't keep up those double-digit, triple-digit gains, for too long. I mean, eventually kind of tones down some, and then maybe that company starts paying a dividend or increases their dividend, it becomes a dividend aristocrat, a dividend king, where they're increasing their dividends steadily over the years, and that turns into kind of like an income investment right there. And there could be times where, the growth slows down and it gets affected more by the market price moves and intrinsic value and everything versus that. So it could become a value investment depending on, because a lot of times growth stocks, they trade at a premium kind of, their PE ratio is going to be higher because they're pricing in that growth and in that future prospective growth. So they have a, PEG, price to earnings growth ratio, that comes into effect and everything that you want to look at. So sometimes that can happen with growth stocks, whereas income investing, that usually stays in the income and value investment realm, and income growth isn't exponential. Income growth is going to be pretty steady. It grows over the years and over the quarters, it can for sure, but it's rarely ever on par with like growth investments, double, triple digit gains, like constantly or anything like that. Gains in income investing is typically not going to be on par with growth investing when growth investing is doing well. There are times where income investing can be doing better in gains where growth isn't doing so well. But overall, when growth investment is doing really well compared to when income investing is doing really well, growth is typically going to have those higher gains if they're actually, capitalized on and everything, whereas income is just going to happen over time and everything. Now, with growth investing, typically the investor has to sell the growth asset to obtain profits from the gains. Whereas with income investing, typically the underlying asset price doesn't move substantially, and most of the gains come from the passive income that the asset provides. So yeah, like for instance, if you have a stable blue chip mega corporation, dividend paying stock that's been a dividend aristocrat or dividend king, they've been increasing their dividend aristocrat or dividend king. They've been increasing their dividend over the years steadily, really nice, bringing in a nice income for you every quarter and everything. Now, eventually, maybe 10, 20 years or 5 years, however, you want to sell that stock. Well, that stock may have not have moved up that much. It may have moved up. You still, a lot of times you will get nice growth. Like for instance, in this portfolio, you'll see when I get to the specific stocks, you can have some nice gains in appreciation of that asset price for sure. But however, a lot of your gains are going to come from that dividend, from that quarterly dividend that's played out and everything. Sometimes the asset price growth that you can obtain can be higher than that passive income for sure. But with the income investing and value investing, a lot of times that asset price doesn't move nearly as much as a growth stock will. However, throughout that time where you've been waiting on that growth stock to run up exponentially to take advantage of that, with income investing, you're getting that steady stream of income though. So it's kind of a versus, but it's not really a versus. Like it's not either or with growth versus income investing with me personally. I know some people are either or with it, but not me personally. Like I said, I like both. Now let's get to these 3 specific stocks that I had in this portfolio that helped me beat the market in 2022. Now, the first stock I want to talk about in this portfolio is Pfizer, ticker symbol PFE. With my investment, I first bought this stock in November 26, 2019 at $36.37. Overall, an average price of $36.94. Now, that's with dividend reinvestments and buying throughout the years and everything. Average price I have for my investment in Pfizer is $36.94. Currently, the stock is trading at $44.16. Now, the PE, price to earnings ratio, when I first invested in Pfizer was around 12.80. Currently is sitting at about 8.46. Now the dividend yield when I first invested in Pfizer was around 3.93% at 36 cents per share. Now currently is trading around 3.77% for the dividend yield at 41 cents per share. The total gain I have in Pfizer throughout my investment from 2019 is 19.53%. On to the next stock. Starbucks, ticker symbol SBUX. I first bought Starbucks in this portfolio on December 26, 2019 at $87.91. My average price is $79.67. I did more buying when it was lower in those ranges right there, $60, 60 something dollars a share, 70 something dollars per share, and then also the dividend reinvestments. Currently, the stock is trading at $109.14. Of course, when you see the video, the current stock price is going to be different for sure. This was as of January 31st closing, so it's definitely going to be different whenever you see the stock price and everything. The PE price to earnings ratio was around 30 when I first bought it. Currently, it's around 38.57. The dividend yield was around 1.69% at 41 cents per share when I first bought the Starbucks stock. Now it's at 1.94% at 53 cents per share. My total gain from holding this stock from 2019 and adding to it is at 36.98%. And now we have Unum. This stock right here was the best performer in my portfolio in 2022 and since I've held it. Unum, ticker symbol UNM. I first bought Unum stock on January 8th, 2020 at $28.89. However, my average price of this stock is at $19.39 because soon after I bought the stock in January, a couple months later, that was when COVID crash happened. And yes, I definitely bought more of this stock in the teens, and it pulled down that average price from when I first bought it at $28.89 all the way down to $19.39. That was dollar cost averaging. I didn't go in all at once. I dollar cost averaged it into the stock more and more because of the fundamentals, because I knew I was going to hold this one long term because I thought it was going to be a great long-term hold. And so far, I've turned out to be correct on that. Now, the current stock price is at $42.03 for this stock. When I first bought it, the PE price to earnings ratio was around 5.4. Now it's currently around 7.14. The dividend yield when I first bought this stock was at 3.8% at 0.285 cents per share. Now it's currently around 3.21% at 33 cents per share. My total gain for Unum stock since I first bought it in January 2020 is at 116.73%. Yes. In a matter of a couple years, my total gain on this 116.73% right there. And this was the best performing stock in my portfolio. This is definitely what helped me beat the market in 2020 the most, because not only did it do that well in my total gain, it is one of my top holdings in my portfolio as well. Now, based on the allocated amount that I have invested in this versus the other investments, it's not substantially more than my other investments. Like I said, none of these investments are substantial at all. Anyways, I'm not rich. Yeah, I beat the market in 2022. Yeah, you see that 116% gain. No, I'm not rich. If I were rich, I would be definitely rich because I typically do pretty well in my stocks and I hold on long term. I'm not a stock picker guru or anything like that. I just look at the fundamentals. I look at the information for the company. I invest in great, typically individual stocks. Sometimes I fall into the hype for sure. And I invest in solid ETFs as well to gain exposure to different sectors and markets and everything and certain stocks and sectors. And I have a great video on my top 5 favorite ETFs, exchange traded funds. Definitely check that out on my channel. But let's get to the chart so you can see how these stocks performed over 2022. Now, yeah, I beat the market in 2022, but as you see right here on the chart, Starbucks and Pfizer kind of had a rough 2022 as well. Yeah, you could have got in at a certain time and done very well in these stocks for sure in 2022. If you were like me and you got into these stocks before 2022, sometime in 2020 or 2019 or 2021, at a certain price and you held on to it. That goes back to that buy and hold investment strategy. Then if you would have held on to it, then you would be doing well in 2022 because your average stock price would be lower than anywhere the stock was at in 2022, depending on when you bought it, how much you bought onto it, where your dollar cost averaging or whatnot, because all three of these stocks fall into the buy and hold investment strategy that I was talking about at the beginning of the video, because I bought them years ago and I've held on to them since then. I've actually added to them since then for several of these stocks, some more than others. Like for example, I added more Starbucks throughout when it was down to 60 something to 70 something dollars a share. Added more Unum as it was dropping in the teens. Didn't add as much Pfizer, but I bought a nice amount up front and I let the dividends reinvest. And that comes back to the income investing strategy, because those are dividend paying stocks and I was letting that passive income from the dividends be reinvested into more of the stock. Now Starbucks, because it's a growth stock and it has that PE ratio that is above that standard kind of, a lot of people say for value stocks has to be under a 20 PE ratio. It's kind of like a thing I've heard, sometimes under 15. Then you could become a value stock depending on other fundamentals. Now that's kind of like a widespread, fact or rumor, however you want to call it. Some people stand by that completely. Some people don't look at that too much. They may look at other factors, the PB ratio or cash flow or something like that. Now Unum and Pfizer, they fall into that value investment strategy because they were undervalued relative to their intrinsic value when I bought them based off the fundamentals. Now Starbucks is more of a growth stock, so it didn't fall into that value investing strategy, but it definitely fell into the buy and hold strategy and somewhat into the the income investment strategy because it is a dividend paying stock. It's not one of the higher dividend payers. It doesn't pay as high as a dividend as Unum or Pfizer. They're more of an income investment stock in that, realm and everything. But Starbucks does pay a dividend, so somewhat of, income investment, but it's more associated with that buy and hold investment strategy that helped me beat the market in 2022. But I want to wrap up the video here. I know it's getting kind of long. If you have any questions or anything, definitely leave it down to the comments. I'll try to respond. So this isn't financial advice to go buy these stocks right now or anything like that. But that's it with the video. Hope you all enjoyed it. Take care.